Hello, everybody. This is Brent Johnson. I'm with Santiago Capital, and I'm happy to be here on Real Vision today. I have the immense pleasure of being able to speak with Bill White, and I'm going to give a quick introduction of him, but he really needs no introduction. He's been on Real Vision several times, and I've been following him for several years and read several pieces of his work. And I got to tell you, Bill, you're lucky we're not sitting on like a 6-hour flight next to each other, because I know I would drive you crazy for the whole 6 hours. So if you get sick of me at any point, you can just hit the stop button on your computer and we'll go from there. But I'm really excited to get to speak with you today.
Well, I'm looking forward to it too. I think it's going to be a lot of fun, and both of us might learn something.
Yeah, absolutely. Well, I know I could learn a lot from you, and I know there's going to be a lot of different things that we talk about. I think maybe just quickly, let's, I'm Santiago Capital. I'm a money manager, for lack of a better word, in San Francisco. If you could just give a quick little background on you, who you are for the people who haven't heard you speak before, that'd be fantastic.
Oh, shucks. Well, I come from a small town in northern Ontario in Canada, and I guess my first big job was deputy governor of the Bank of Canada. And then I subsequently went and became the economic advisor, running the economics department at the Bank for International Settlements, which is where all the central bankers meet up in the old days, every month, and more recently, every 2 months. And then I was the chairman of the Economic and Development Review Committee at the OECD, which does all sorts of country surveys. And now I'm semi-retired back in Canada, and I'm a senior fellow at the Howe Institute in Toronto.
Fantastic. Well, I think one of the reasons I think that I've been looking forward to speaking to you today is I think as I've moved forward in my career, I've at times been fairly critical of central banks from the outside looking in. And when I look back at some of your work, you have, I think it's fair to say you've been somewhat critical of central banks, but you've done it from the inside looking out. And so I think it's kind of an interesting place we find ourselves in now, with both of us having those viewpoints, but then also with, central bankers are like celebrities these days. People actually know who they are, and they're, highly quoted. 10 or 15, 20 years ago, I don't know if it was necessarily the case, but it's certainly interesting times as it relates to central bankers.
Yeah, absolutely. And it's sort of funny in a way, because the central bankers were really at the heart of the crisis, and having allowed sort of very rapid credit expansion in so many countries prior to the great financial crisis. And one might have thought that there would have been some kind of a pushback on the central banking community. But rather oddly, there has been even greater reliance on the central banks to keep the system afloat. And in addition to their monetary policy responsibilities, of course, they've been given an awful lot more regulatory responsibility. So they're now even more important than they were before.
I find that kind of amazing as well. And I guess one of the questions I had for you initially is the fact that you started worrying about a potential crisis, back in the late 90s, early 2000s. And I know you presented a paper at the, Jackson Hole Federal Reserve Conference that was, not well received, I guess is the right way to say it. And so my question to you is, were you always kind of a rebel, or were you always somebody who kind of pushed back against the authorities? I've heard you use the term the authorities before. Or did something happen at some point in your career where you said, aha, this is different than what I thought, and therefore I need to now start pushing back? Were you the guy that wore the brown suit, in other words?
Yeah, I guess I've always been a bit an intellectual rebel. It was certainly helped when I went to the Bank of Canada. Like, I started my career at the Bank of England after I did my PhD, and then I went to the Bank of Canada. And I do remember a cocktail party at around 1974, 1975. And the Minister of Finance was there, and he was about 6'5". And he was being spoken to by my then mentor, a deputy governor called George Freeman. And I can see George now looking up at this big, tall guy, and he was about 5'6". And he was pointing up to him like this, up at his chin. And he said, quote unquote, "Minister, how can you possibly believe that?" And this idea that just because people say something and just because they're in positions of authority, it doesn't mean that they have to be right. And when you look back on history, I mean, think back to some fundamental things like, is the Earth at the center of the solar system, or is it the other way around? And people believed the wrong thing for thousands of years. And we continue to believe an awful lot of things that are not true. And so I think having a capacity to suspect that there might be false beliefs and to pursue those false beliefs and to try to show that they're false beliefs, I think that's an important attribute. And everybody really ought to try to cultivate that capacity.
But isn't that somewhat rare within the circles you used to work? I mean, it seems to me that all these central bankers at different countries, not necessarily just the Fed or the Bank of Canada, but they all kind of went to the same schools. They all subscribed to the same theories of thought. They all use similar models, from what I can tell. So for someone like you to kind of try to mess with those models, or I would think that would maybe get some sideways looks in the office from time to time. I'm just curious how you were received by your colleagues.
Absolutely. Well, you made reference to that presentation that I and Claudio Borio, who is my close, colleague at the BIS, presentation that we made, and was almost the logic was almost universally rejected. I think the only person there was Mike Musa, now sadly dead. He was then the head of the IMF research department, I think. He was about the only person there who said there might be something in it. One of the problems, I think, it's not so much with the central bankers, but it's almost with the academics. And you made reference, all went to the same schools, and you all learned the same models, and you have the same view about how the world works. And I guess my contention would be that, and I've written about this on a number of occasions, is I think the central bankers, and for that matter, the macroeconomists generally, have made what I call a fundamental ontological error. It's a philosophical error. The question at issue is, what is the nature of the beast? What is the nature of the system that you're trying to control? And the sort of almost universal belief is that it is simple and static, and therefore it is understandable and controllable. And my contention would be, no, it is not simple and static. The economy is a complex, adaptive system, like many other systems in both society and in nature. And that means that it is not fully understandable and it is not fully controllable. And we should really have a different starting point. Now, when I was at the BIS, I would have to say that this terminology of complex adaptive systems, with which I'm now becoming more familiar, I wasn't really thinking in those terms. But what we were saying at the BIS, and I continue to believe that it's true, is that the most fundamental problem is not the business cycle. The fundamental problem is the financial cycle. And the financial cycle is basically fueled by credit expansion. And it's the boom-bust thing. And if you look back over the course of the last 30 years or so, that really has been the problem. It's been boom-bust as opposed to, oh my God, inflation is out of control and we have to tighten up and control it. That has not been the case really since the early 1980s. So we need almost a different philosophical orientation, a different starting point for the analytical process.
Well, one of the things that's always kind of amazed me, and it took me a long time to figure this out, but I had a kind of a fortuitous meeting in the mid-2000s with some clients that kind of led me to search into how the actual monetary system actually works and the way it's designed and the way money moves. And what I came to realize was that, in my opinion, the system itself, the design of the system, is inherently unstable. And I find that interesting because, to the extent that central bankers, they all have these models and they all have these mathematical frameworks, and they think if you push this button, then this happens. And they have these complicated models, but the very simple model of which the system is based on, in my opinion, is flawed. And that is that if you loan money into existence, the debt is always going to be bigger than the capital off of which it's levered. And then you get into a system where for it to remain stable, it has to grow. But if anything grows forever, it'll eventually go exponential. Mm-hmm. And exponential curves never end well. They either go up and you have huge inflation or whatever it is, or it crashes and you get the bust. And so I kind of find that there's a contradiction to me that they have all these very incredible complicated models, but the very simple model of the exponential system seems to be beyond their grasp.
Yeah, well, the fundamental problem, and unfortunately, this contradicts what's in a lot of the textbooks. Okay? The fundamental problem is that the banks do actually create money out of nothing.
Right.
When you go in and get a loan, they basically just write up both sides of the balance sheet. And this is a sort of a variation on sort of fractional reserve banking that goes back really to the Venetians. It goes back hundreds and hundreds of years. And we put up with this system basically because it greases the wheels of commerce. Right. That if you have this kind of capacity to get credit without actually having prior saving, and therefore investment or spending, there's certain advantages to that. It keeps the system rolling along. Unfortunately, there's two sort of problems, and I think you're sort of alluding to it, but perhaps in a somewhat different way. One of them is that this process of sort of creating the money, in a sense, it's so easy, it can very easily get out of hand.
Yeah.
And that really is the basis for this sort of boom-bust kind of problems that we've seen really from since this system was brought in. It can get out of hand.
Yeah.
The second thing that worries me, and this is sort of closer to what you're alluding to, is that there is a kind of fundamental intertemporal inconsistency, which implies an unsustainability over time. And the way that I've been describing it is that when you sort of basically use easy money, think about sort of in the downturn, to get out of a situation, you induce people to bring spending forward from the future by taking out debts, by
right.
credit, debt, spend the money. And it works. But the problem is that the debt, we can go into how you might get out of this, but generally speaking, what's happening is that increased debt then acts as headwinds in exactly the same way as if you're using your credit card. And you sort of, you use one credit card to pay off another credit card. The debts are getting bigger and bigger. Eventually, you can't get any more credit cards. And that in a certain sense, it's got to come to a stop. It's unsustainable. So this is a fundamental problem with the system. There is a fundamental flaw. There's many different ways in which you could deal with those flaws. But the idea that there is something... what's the word? There's something fishy in the state of Denmark. I think you're quite right.
Yeah. Well, I read in one of your papers, you quoted a famous Mark Twain line, and I always quote a famous one as well. But you said, the one you quoted was it ain't what you don't know that gets you in trouble. It's what you know for certain that just ain't so.
Yeah.
So I guess one of the questions I have for you right now, what do the monetary authorities think they know that just isn't so right now with what we have going on? Is there a problem that you see that they should be more aware of that they just don't seem to recognize?
Well, I think this intertemporal thing that I mentioned still has not gotten widespread acceptance. When you go back through the last sort of really since the early it started, I guess, with Chairman Greenspan, the Greenspan put in 1987. The idea that monetary expansion will always work to increase aggregate demand, that's not true because of the headwinds.
Right.
And the second thing that's not true is the belief that the unintended consequences of monetary expansion, credit expansion, are not serious enough to be a constraint on the exercise of easy money, that too is not true. So basically what you come down to in my sort of belief system is that you can't use easy money forever because it won't work and because the side effects will come back. And if you'll pardon the expression, it will come back and bite you in the bum.
Yeah. Well, I think the other part of it, too, I'd like to get your thought of this is because, on the one side, you have the central banks who kind of has designed the system, for lack of a better explanation. But then you also have the fiscal side or the governmental side who, of course, they want to spend money. They get elected by spending money. You don't become popular by reining the cash in. You become popular by sending the cash out. And so, because of these boom busts that you were talking about, it seems like every 10 years we get one of these crises, and then when you're in the middle of the crisis, the politicians say this is not the time to fix the problem. We're in a crisis right now. Let's just save the patient. But then
absolutely.
Right, and there's a certain truth to that, but the problem
inevitability.
is inevitability. Right. And so the point is like no politician is ever going to be the one to take the hard medicine. Because as soon as they start to take the hard medicine, another crisis develops, and then you have to save the patient again. So I guess my question is to you are the problems that you see, are they fixable?
At this juncture?
Yes.
They're certainly not fixable in the traditional way. I think the expansion of private sector debt and credit through monetary expansion, and I've really just talked about that. It's been used over and over, and I'll tell you honestly, Brent, the biggest mistake I've ever made in my professional career was underestimating how well the central bankers could actually pull the iron out of the fire. They've done this repeatedly. I guess I'm sort of going out on a limb and saying I think this time it won't work. But certainly we're getting much, much closer to the end game.
Yeah.
And I think that's one of the reasons why in this particular crisis, now I'm thinking about the pandemic and COVID and the rest of it, that there has been a general agreement that fiscal expansion has got to be used much more than it was after the great financial crisis. And I think that general view had been building in the academic and the central banking community, even before the pandemic hit.
Yeah.
There's more and more talk about, monetary expansion has reached its limits, mostly in the context of having hit the zero lower bound and not being so sure about whether the effectiveness of the non-conventional instruments. So now there's sort of much more of a willingness to say it's got to be fiscal. Yeah. And in some quarters, I think some people saying maybe we should have stuck with fiscal expansion more the last time and relied less on monetary because it's brought us to a bad place. But we are where we are. And now people are saying we're going to have to use fiscal much more than previously. And of course, complement it with continuing to have ultra easy monetary conditions.
Sure.
Both fiscal and monetary. But there's limits to that too. And when you go back and you look, for example, at some of the work that Larry Kotlikoff did, the intergenerational accounting stuff, where you basically look not just at the on-balance sheet stuff of governments, their contractual obligations like bonds, but you had in all the off-balance sheet stuff, which is the Medicare, the Medicaid, the pension funds, the contingent liabilities. The numbers get to be very, very large very quickly. And for all practical purposes, if you do the numbers, most governments are, from that technical perspective, insolvent. In the sense that they can't meet the intertemporal budget constraint without very significant increases in taxes. So on the fiscal side, we're also in a place where we don't want to be. And it's the reason is very similar to why monetary policy is ratcheted down to zero. Because in every sort of every downturn in the economy, monetary policy was eased significantly more than it was tightened in the subsequent recovery. And so in both nominal and real terms, the interest rates just ratcheted down and down. Well, fiscal is equally asymmetrical, because whenever you got into a downturn, the automatic stabilizer to kick in, or discretionary spending, and there'd be a big increase in the deficit and debt. And then it was never redressed in the subsequent upturn. And so the debt levels just kept ratcheting up and up. And so we are where we are. And now with this most recent thing, it's taken another turn for the worse. Now, I personally believe, I said before, from a technical perspective, the governments are all insolvent. But the markets, have actually been very patient with virtually all of the big guys. And basically said, I can do the maths, the technical stuff, but I think you'll sort this thing out in the fullness of time in a non-inflationary way, and therefore I'm prepared to give you the money.
Right.
And I think the markets will continue to be patient, for the big guys at least, for a significant period of time. So it's probably right to bring the fiscal weapon back into the macro stabilization. But, and this is again my own view, the market's patience is not infinite. And I think at the same time as governments say, look, we have to do what we have to do, I would really like it if they could also lay out a plan to, in a credible way, indicate that when the recovery occurs, that we are not going to go back to a world in which we will allow the debt levels to maintain, to rest at a permanently higher plateau. I really wish they would do something about that. Another thing that's inevitable at this stage of the game, it seems to me, given the levels of debt that we have, both public and private, is that there will be a significant increase in the number of insolvencies and restructurings. And we really ought to be, we should have been doing this for decades, putting much more effort into ensuring that process of restructuring, liquidation, write-offs, that process will be as seamless and as orderly as it could possibly be. And we haven't put anywhere near as much effort into that as we should have done. And there's been repeated calls from the IMF, from the OECD, from the Group of 30, pointing out the inadequacies in our legal and administrative frameworks. We should be putting a lot more effort into that because it's coming down the road.
Absolutely. Well, a lot of the stuff that you just touched on, the fact that we've kind of reached the lower bound on interest rates, and we've gotten these huge debts on the fiscal side, and they just can't go on forever. It's kind of led us to this new paradigm or potential paradigm of this MMT, where instead of instead of loaning money into existence, you spend money into existence. And the idea that the government can just spend whatever they need, and the inflation, or they try to control the inflation rate rather than the interest rate. And I think that's been picking up speed, because I think they're starting to realize, to your point, that we're kind of at the end of the other two options. So, but then this also kind of, it gets all very complicated, but it kind of starts to merge the Treasury and the central bank, right?
Yeah.
Those two functions kind of get blurred. So I have two questions for you that kind of relate to this. One, are central banks really independent? And two, when a push comes to shove, who has the final say? Is it the Treasury or the central bank?
Well, I helped to write a speech for my then governor, John Crow at the Bank of Canada, back in the early 1990s. And he'd been given some award, and we had to write a speech for him. And it was about central bank independence.
Okay.
And I remember very clearly, this is back in the early 1990s, that I and my colleague Chuck Freeman, I was working with, realized that this word was not a good word. That it was much better to think in terms of a central bank has got a mandate, a central bank has powers to carry out the mandate, and it has to be held accountable for meeting its mandate. And then you said, where did the mandate come from? Well,
Right.
in general terms, in a democratic society, the mandate comes from governments.
Right.
And you say, well, and you're going to be held accountable. Well, held accountable by whom?
Yeah.
And the answer is by governments. So in a democratic society, independence in some broad sense doesn't make any sense.
No.
Okay, where we are all accountable to the people in some
Right.
fundamental way. What it does mean, I think, and I think Stan Fisher pointed this out first, that it's what we really mean by instrument independence. That once you've been given the mandate, then you have to have the independence from political influence, short-term political influence, to do what Parliament or the government has told you longer term that you should do. That's your mandate. Yeah. So independence, we've never been independent in a broader sense.
Right.
And I think what too is also becoming increasingly obvious is that central banks have always been worried about financial stability. I mean, when you go back and you look at the history of central banking, aside from financing wars, which is, I guess, the first reason that they were set up, financial stability has been core to what they do. So to say that it's not part of what they should do, and as soon as you get into the financial stability business, the central banks have got some responsibility for that. All sorts of other players are in that game as well, right? The government's interested because in the end, the government may have to pay up, okay? Yep. The deposit insurance people are interested. The financial regulatory people are interested. So you're into a world now where you know the central banks have got to work more closely with other people. And when you think about QE, okay, so financial stability means independence is blurred in a sense on the financial stability front. But as soon as you get into QE, you know, now what we're talking about is there's an overlap there with fiscal policy too, you know, because the central bank is now basically into the debt management business. Yeah. So it was a nice period of time. I do remember that, you know, when I was at the central bank at the Bank of Canada, and you had a clear mandate, and you used these sorts of terms, you know, and you sort of felt somehow that you didn't have to think about other people's concerns. But I think increasingly we realize it's not that simple.
So when you were either at the Bank of Canada or Bank of England, was there, or any, I guess it doesn't matter, any of these places, was there a person either within your field or without your field, outside of your field, that you either saw as a mentor, or that you really looked up to, or that, you know, you thought that you would kind of model yourself after?
Well, this guy, George Freeman, that I was talking about earlier on at the Bank of Canada, you know, the one who, minister, how could you possibly believe that? That guy taught me a lot of lessons. I remember once I had written a speech, a presentation to be given at SEMLA, which is the central and basically the central banks of the North and South America. And I'd written a piece about how the Bank of Canada conducted monetary policy. And I was told the day before I couldn't give it. It was too, you know, sensitive. And I stayed up all night writing another speech, and I was angry. And I went to see this deputy governor one day to tell him how angry I was after this had happened. And it was the senior deputy governor who'd blown the whistle on me. Okay. And the deputy governor was not there. So I sat and waited, and in he came with a sheaf of paper. And he threw the sheaf of paper into the waste paper basket. And I said, "What's that?" And he said, "It's the speech I was going to give. The senior deputy governor didn't like it." Threw it into the waste paper basket. He said, "What are you here for?" "Nothing," I said. I just came to see how you were. And that just taught me a huge lesson. That it doesn't matter how senior you are, you know, that there's always somebody else whose opinion you have to take into account. Yeah. And that's just the way the world works. And And in addition, and this came from George through various other means too, you should be very humble, always, because it could well be that what you believe is actually wrong.
Yeah.
And I've had this a number of times in my own life, and I don't rule out all my conversation with you. I don't rule out the fact that I may be saying nonsense once again.
Yeah.
I hope not, but...
Well, you just touched on something about, there's always a boss. There's always a bigger boss. There's always somebody that you have to answer to. I think this is interesting as it relates to the Bank of International Settlements, because I think in the popular narrative, or at least the general public who is even aware of the Bureau of International Settlements, or people in the finance world or the precious metals world, the Bureau of International Settlements either has a very high connotation or a negative connotation, depending on whether you support central banking or don't support central banking. But the question I have for you is, I think the popular narrative is that the Bureau of International Settlements is the central bank for the central banks, and therefore they are the bosses of the central banks, and it all flows down. But I've heard you speak about, so I'd love for you to, for people who haven't heard this before, I'd love for you to talk about that a little bit, because I know you've said that you would give, as the Bureau of International Settlements, you would give ideas and suggestions, but in many cases they just ignored you.
Yeah, well, it's Bank for International Settlements. Yeah, it's the BIS.
Sorry.
BIS. Yeah. Anyway, that's a total. That popular understanding is a total misunderstanding.
Okay.
We are. I remember when I first arrived at the BIS, thinking I was going to another central bank, and it took me about 2 weeks to realize I was no longer in the central banking business. I was in the tourist business. And the BIS is a bit like the OECD. It's a host for meetings. That's all it does. It's a host for meetings. So, for example, not in the monetary policy sphere, central bankers all meet at the BIS, but in the regulatory sphere, okay, the Basel supervisors all meet at the BIS. And the BIS provides a secretariat for them. In the same sort of way as when all the central bankers meet at the BIS, we provide secretariats to support the meetings. But all of the decisions, whether on the regulatory side or on the monetary policy side, on the regulatory side, there are decisions taken at the BIS, but they're taken by committees made up of the national experts. Okay, it's not the secretariat of the BIS that's making the decision. It's the regulatory people meeting there, and insofar as the monetary policy side is concerned, there are no decisions taken at any of those meetings. Okay, but it's just a place for exchanging views. So people get a kind of heads up about what the Fed is thinking, what the Bank of Japan is thinking, or whatever. But no decisions are taken. And that gets us back to the discussion we had here just a few minutes ago about the belief system. Because the belief system that most of these people are operating under is that each central bank should be conducting its own monetary policy within a regime of floating exchange rates, in which case it is possible to have an independent monetary policy. So all of the big guys are actually sort of looking at it from that perspective. So there's no sort of BIS view that sort of comes down to the central banks, which they then go dutifully back home and implement. Far from it. I think they often, in fact, I'm sure of this, they've listened to what we had to say over many, many years and then totally ignored it.
And so when that would happen, when you'd have a meeting and when you'd make suggestions and they would discuss it and then go back and do something else or ignore it, I guess from your perspective, was that I mean, obviously it's not encouraging, but did it become discouraging? Was it frustrating, or was it just you just understood that's the way it was?
Well, we were obviously discouraged. I mean, I remember on one occasion we'd written a paper that was being discussed at a meeting, I think it was called the Global Meeting. And it was basically a statement that credit expansion was a real problem, and the growth of global liquidity. And the whole discussion got totally bogged down in a discussion of what does it mean, how do you define liquidity and shifts in demand for money functions and all this kind of stuff. And the basic message seemed to me to just have been lost. And I can remember coming back to my office with my colleague and saying, it's like, what's the word? It's like a Greek tragedy.
Yeah.
That you can sort of see this thing coming down the road and you don't seem to be able to do anything about it.
Yeah.
But one of the questions that I remember putting to myself was maybe we should have been much, much clearer in terms of our cries about, we're going down a bad path. But the real problem was that I think we sort of pushed it as far as we could without getting the central bankers, who, I remind you, were the chief shareholders, without pushing back and saying, well, no,
Yeah.
I've got 1,000 PhDs working for me, and they tell me that my way of looking at the world is right, and your way of looking at the world is wrong.
Yeah.
And who are you guys in Basel anyway? And it's a fair cop.
Yeah. Yeah.
So sometimes, everybody was always respectful. I mean, no question about it. I mean, nobody ever sort of turned on us and, said bad things about the House view.
Yeah.
But they just chose not to accept it.
Well, it's funny because you brought up the concept of you see a Greek tragedy to a certain extent. And, I would share that sentiment. And I think that in the long term, I think that gold will do very well and maybe even return to its center in the financial universe. But the thing that I've been most focused on in the last couple of years is the penultimate chapter that comes before that ultimate reemergence of gold, and that is the tragedy that I see is of the dollar. And when most people think of the dollar, I think a lot of them think that the system is unsustainable. The debts are too big. They must be inflated away. So therefore, the dollar is going to go lower. And I initially thought that. And over the last several years, I've kind of changed my view 180 on that. To your point of it's not what you don't know that gets you in trouble. It's what you believe that just ain't so. Yeah. And for several years, I believed the dollar was headed lower. And when I finally came to the realization or the belief, because I could be wrong, but the belief that before that happens, the dollar is going to go much higher. And I think that's the crisis that's coming down the pike. And, to your point, the extension of credit has, gotten to these levels that's unsustainable. And I think that's happened in every country. I don't think that the United States is unique in that situation. Canada's in very bad shape in that regard. Australia is not in great shape in that regard. Europe itself is not in great shape. Just about everywhere you go, you see the same thing. But what I found most distressing or most problematic is the fact that while each country has, developed these problems in their local currency, on a global basis, they've developed it in the dollar basis. In other words, the dollar debts around the world have gotten to a point that they're just not sustainable. The deflationary effects of all the previous debt that's been issued. And then in the last 10 years since the global financial crisis, the speed with which the dollar debt has been issued on a global basis, there's almost as much dollar debt owed by entities outside the United States as entities inside the United States.
Yeah. I think the dollar assets of non-U.S. banks are about the same volume as U.S. banks. Yeah. Right. I know it's a big issue.
And with this case, the big issue is that, to your point, there's two ways that money get created. Either the central bank, puts collateral into the account, or the commercial banks loan it out into existence. But when you've gotten to the end of the credit extension or the commercial bank's ability to create it, and it starts rolling back in, the country's central banks outside the United States don't have the ability to add dollars to the system to recollateralize it. Mm-hmm. And so it's come to the Fed to collateralize the whole world. And we saw that kind of start to pick up pretty rapidly in March. That was somewhat quelled by the fact that the Fed came out and offered swap lines to various central banks. But in my view, and I'd love to get your thoughts, in my view, these are temporary solutions at best. And I think the idea that the Fed can bail out the rest of the world via swap lines, while in theory possible, is politically impossible, or not impossible, but not as easy to do in reality as it is in theory. And I've heard you say before, what should happen and what will happen are not always the same thing.
Oh, absolutely.
So I'd love to get your thoughts on the dollar debt.
Clearly, I mean, it is a huge problem. I mean, if you look at the debt numbers, global debt numbers collected by the Institute for International Finance, I think in 2008, global debt as a proportion of global GDP was 280% in 2008. At the end of 2019, it was 320%. So if you thought the global financial crisis was a time of deleveraging, think again.
Right.
Okay? Now, what was interesting about that increase, it was almost wholly outside of the United States and in very large part in emerging markets.
Yep.
Okay. And I guess what worries me, and this goes back to your strong dollar thought, was in 2008, the trigger for the crisis and the sort of epicenter really was excesses in the United States, okay, subprime and all that stuff. Mm-hmm. And yet, even though the US was in some sense the trigger for the problem, the dollar went up, not down. Exactly. And that flummoxed some people like Nouriel Roubini and others who've basically been saying, you know. So if the dollar was the epicenter of the problem, and yet when the problem emerged, the dollar went up, how much more likely is it if the epicenter of the problem turns out to be outside the United States at the moment?
Right.
And then there will be this flight back into dollars for safety. The other thing is that, and you've alluded to it, is it's the particular component of the kind of debt that has emerged. And one of the problems, as you are well aware, is that a lot of this debt in these issued by people outside the US that do not get their primary revenues in dollars, the debts that they've issued are dollar denominated. And I think the BIS estimates are something like $12 trillion worth of it out there now. Mm-hmm. And China is a very big part of it. And I think the numbers I've seen indicate that of that dollar debt, I think 30% of it has been issued by the financial sector. 40% of it has been issued by property developers, mm-hmm. which just sort of makes you feel a bit sort of edgy to begin with.
Yeah.
So there will be a kind of dollar shortage. Claudio Borio and others at the BIS have pointed out too that when you add in all the swaps and the derivatives, that there's implicitly sort of still more borrowing going on in dollars.
Yeah,
I think going to have to be repaid.
I think the number's much bigger than, and I think even on the Bank of International Settlements website, I mean, which is fantastic for data. The stuff I've looked at, you know, the popular number is that 12 or 13 number, but when you start like really looking deeper, it can easily go to, you know, twice that amount. So it's a big problem. And so, but what I really wanted to speak about was, again, on the swap lines was the ability for the Fed to bail out the rest of the world via them, because, you know, I think it gets tough for, you know, Powell to give a swap line to the ECB, who gives a swap line to France, who gives a swap line to Airbus, if we're also trying to bail out Boeing. Issues like that, right? There becomes political issues that I think maybe supersede what the financial system is desiring.
Well, the comments that I've just made were designed to support the view that you've got that Houston, we have a problem.
Yeah. Right.
But the next question that you've just raised is, well, what are you going to do about it? And one thing that worried me a lot before the crisis, I mean, I've been making presentations, you know, with the the title, Are We Prepared for the Next Crisis? And the answer is no. And one of the things that I've been really worried about has been this liquidity thing. And Jay Scott from Harvard wrote a book here a little while ago in which he points out that there's at least half a dozen provisions in Dodd-Frank that basically are going to tie the Fed's hands behind their back. And Janet Yellen has said she's worried that the Fed may not be able to respond in the next crisis the way they did in the last crisis. Well, they've done even more this time, and there's been a lot of worries about the the legality of. Yeah. I'm not raising this issue, but other people have raised the question of whether what the Fed is doing, the ETFs and whatever, is actually going beyond their legal mandate. But my thought was that if the Fed was going to run into constraints in terms of domestic provision of liquidity, surely implicitly there would be constraints on their provision of liquidity internationally. Well, the crisis hit and the Fed opened up these swap lines and in a very aggressive fashion, which I was very thankful for. Because I had been worried right from the start whether they would be able to do it. But they have done it. But you're right that the more they do it and the longer it continues, the more likely it is that there will be a kind of congressional pushback. Now, I don't profess to be any kind of expert about that kind of thing, but certainly raising it as an issue, how far can we go here? It's an important question to ask. One of the big differences is that the last time in the great financial crisis, the swap lines were basically with people who were largely European and the Japanese, not totally, but largely, who were sort of, friends and neighbors. And now the situation is a bit different because there's a lot of people, not least of whom the Chinese, who are in this position.
Yeah.
And it's not at all clear that the political road to the Fed being able to sort of help them, that road is going to be open to them. So there are some concerns. The other thing, closely related is, aside from the dollar liabilities, it's just the overall debt burden. I think the IMF estimates now that something like 40% of all the low-income countries are either sort of in a debt crisis or on the verge of a debt crisis, and that was before the pandemic hit.
Right.
Okay, that was the October Global Financial Stability Report of the IMF. So even before the pandemic, these people were in a very sort of risky situation.
Yeah.
And then the question becomes, how do you deal with them?
Right.
And I think the fund has already said that they've had something like 90 or 100 countries that have either come in for help or have said they want the fund to start looking into the prospects for getting more help. Right. So the debt issue more broadly is a big issue.
Yeah.
And the very specific question of the dollar financing is a still more specific and dangerous.
I think a lot of people too don't quite understand that these swap lines, they're not gifts. We're not sending them dollars for free. No. It's basically the extension of a loan. So it's not solving the problem. It's kicking it down the road again. It's to a certain extent making the problem bigger. And with the COVID crisis, we talked earlier about how the money either needs to be moving in the system or new collateral needs to be added to it. The money's not moving because people aren't moving, right? With the pandemic shutdowns, and so it made a problem that was already very large and exacerbated it. But there's to this point, and this is going to be a little bit of a jump, but it is somewhat related. I need to make sure I ask this of you, or else I'll kick myself later. Over the last couple of years, with the way that Donald Trump has tried to renegotiate trade and the global order. And, we've kind of gone from a unipolar global supply chain to now talking about dual supply chains. And, countries that are friendly with us maybe get the swap lines, and those who don't maybe don't get the supply chains. And because we are in this crisis now with COVID, you could almost think of it as like not a warlike situation, but a crisis situation. And government and monetary policy and fiscal policy could be driven in a crisis type situation or a warlike situation. And I have to ask you about this documentary and this book called The Princes of the Yen, who a man named Hugh Hendry brought it up a couple of weeks ago in an interview that I heard. And I had watched this interview or this documentary maybe 7 or 8 years ago, but I'd kind of forgotten about it. But I went back and watched it again. And what Japan did coming out of World War II, out of their crisis of World War II, is they did this concept called window guidance, where the Bank of Japan, in conjunction with the Ministry of Finance, so kind of working Fed and Treasury together, they basically mandated that the banks give a certain amount of loans every month or every quarter. And, it wasn't a matter of whether they were creditworthy. That wasn't the criteria. The criteria was the amount of loans. And so my question to you is, as we get into these, further into this crisis and we get into these problems of low growth, deflation, Japan was able to push out of deflation by just spend, and the extension of credit. And even though we're already kind of at the end of this bubble, so to speak, I'm curious if you think that could be done by Japan or the Fed or Bank of Canada.
Forcing people to make more loans.
That's right.
Well, I think we're a long way from that kind of a world.
Yeah.
Not least, I think, because people are increasingly aware that many of the loans that were made in the past were made to people who ought not to have received them in the first place.
Yeah.
And secondly, growing suspicion that, starting in Japan, going back a long time, suspicion that a lot of the loans are really loans that have been extended to people who can't pay back the principal.
Sure.
And for that matter, can't even pay the interest.
Yeah.
So the idea that one would sort of come in with a heavy government hand and say, we want you doing still more of what you've done. Yeah. I don't think that's going to happen. I think what's much more likely is that there will be a recognition, as I said earlier, that there are a lot of loans there that will not, in fact, be serviced, and that we have got to face up to the fact that some of these debts are bad debts. Yeah. And we're going to have to restructure them in a much more aggressive way than we've been doing up until now. And I've noticed just in the course of the last few days, I think there was an editorial in in fact, I think it was this morning in the FT. The FT is suggesting that we've got to prepare ourselves for that. And I'm saddened that it's come to that. But if it is a reality, then as in all things in life, the sooner you wake up to the reality and say, that's the problem and this is what we have to deal with, the better.
But aren't central banks, for the most part, reactive agencies rather than proactive agencies? Don't they typically wait for the crisis to happen and then try to solve it, as opposed to getting ahead of it?
Well, I think you're right. I mean, you made reference earlier on to the presentation at Jackson Hole. And I guess there, what we were basically saying, and I continue to believe it's a viable strategy going forward, is that central banks should recognize that excessive credit creation in the boom is the problem. It also determines not just the bust, but the magnitude of the bust, and that a sensible system would lean against the upswing with both monetary tightening and the tightening of so-called macroprudential instruments to try to lean against the upswing. But there's been, dating from Chairman Greenspan's response in 2003, that's not the way that they've decided to do it.
So in your experience, when these crises have happened in the past, whether it was the Asian currency crisis or the 2008 great financial crisis, behind the scenes, whenever central bankers come on TV or when they write things in the FT or whatever, they always sound very confident and, we've got this under control. But behind the scenes, was there ever, not panic, but was there ever, discussion, Jesus, what are we going to do this time? Or do they just have absolute faith in their models that they'll work?
Well, you do remember in 2009, I think it was, Jean-Claude Trichet lamenting the fact that they'd relied on all of these models and that the models had proved palpably wrong because they start off with the fundamental assumption that really big crises can't occur. And if they do occur, they'll self-equilibrate in a short period of time. Well, when the crisis occurred, the first of those propositions was wrong. And Jean-Claude immediately stated that he could see there was a problem with the analytical apparatus here.
Yeah.
But, the problem is that since that time, even though there's been a kind of grudging recognition that there was something wrong with the analytical framework, what the central banks have done since 2009 has essentially been more of the same, which is ultra easy monetary policy based on the two assumptions that I mentioned earlier, which is that it will work to stimulate aggregate demand in an effective way, and that it won't have any intended side effect. And unfortunately, it worked so ineffectively, it had to be maintained for a decade, during which period of time, these imbalances, not least of which was an expansion in overall global debt, just that expansion got, as it were, bigger and bigger.
I mean, it kind of reminds me of that other Mark Twain speech, and I've asked other people this before, as I said, with regard to the authorities, is, are they smart people who are just putting us on, or are they idiots who really mean it? And I'm of the belief that the central bankers and the monetary, I think they're actually very smart people. I think they're well-intentioned. I think that they're maybe misguided from time to time, and they have too much faith in their models and their beliefs, but it's interesting to see when you get into these situations. At the end of the day, that's what central bankers, that's their mandate is to, provide stability and to step into a crisis. So to think that they're going to stand back and not act when that happens, I think is misguided as well. Of course they're going to act. Of course they're going to try to stop the crisis.
Well, there's two questions. I mean, they've done what they've done. Now the question is, do they really believe that it would be effective and not have side effects? I think to some degree they did, although clearly there were sort of doubts being raised in various corners of the community. Keynes, what is the line that he uses? It is astonishing the things that a man can believe if he thinks too long alone. Or if, that's in the intro to the general theory, I think. But, if you have a community that sort of is, went to the same schools, they basically got the same models. So there's an element of that. But the other thing that you have to keep in mind is that the central banks did what they did, let's say, in 2009 and 2010. And then just as they might otherwise have been thinking about renormalizing, every other aspect of public policy basically went into the opposite direction. So regulatory mechanisms got tighter and tighter. Fiscal policy, whereas it had been very expansionary in 2009 and 2010, went sharply into reverse. And so there was this sort of community of people sort of wanting to renormalize on the one hand, but realizing that all of the other forces were moving in the direction of lower aggregate demand, not higher. And yet underlying it all was the desire to have higher aggregate demand. So this was the line, they were left as the only game in town, and basically were sort of almost forced to do what they did. Yeah. So it's a broader set of concerns, it seems to me, than just simply sort of looking at the central bankers. I think you have to look at everything else that was going on as well. And indeed, I think I would say that even back 2009, 2010, I'm saying now, there's going to be more restructuring and more insolvencies, and we should prepare ourselves. We should have been doing much more of this kind of stuff much earlier on. I think in addition, as we think about how the system could have been made safer, how we could have avoided being in the current situation, if there'd been much more reliance in the system on equity as opposed to debt, if people had not been allowed to buy back in as many shares as they did, buying them back in with the issue explicitly of bonds in order to get the money to do the financing, to buy back the equity, all of that stuff in retrospect looks like it was enormously dangerous and ought not to have been allowed in the first place. Yeah, that should have been done years ago.
Absolutely. So I've got one other question here that I need to ask you, and that is, I know in a previous interview that you did with Grant, you mentioned that in all of your dealings with the various central banks and monetary authorities, you didn't see much of an appetite to return to gold or have gold be part of the system. My question to you is, as we get towards the end, I think a lot of us, and even not just you and I, but you're starting to see more in the popular press that, gosh, we're kind of getting to the end of this stuff. How much longer can these programs go on? And one of the things that people often say to me is that if the problem is the dollar, the rest of the world is going to get tired of the U.S. using the dollar as a weapon. They have too much control over it, et cetera, et cetera. They should just get together and leave the dollar. And I guess my question to you is, if you never saw any appetite to return to gold, did you see an appetite to de-dollarize? And then if you could also just briefly talk about how hard it actually is to de-dollarize from the system, or maybe you don't think it would be hard, but I'm just curious your thoughts on that.
Well, in terms of the of de-dollarization, now I have to, I've been outside this community for a long time, right? So what the current discussions are, I have absolutely no idea. But the reality is that the U.S. as a proportion of total global production, their share of global GDP has been going down for years. And in some sense, the importance of the dollar ought to have gone down commensurately, but it hasn't. Mm-hmm. So the dollar, its share of reserves is as high as it's ever been. The amount of invoicing of trade in dollars is probably higher than it's ever been. And the reality is that you get these enormous network effects, so that as long as everybody's using the dollar, both for invoicing and for provision of financial services, very hard to think of an alternative. And it's only recently, since the Trump administration and the aggravated, right? Because the U.S. has been doing this for a long period of time, but the exaggerated or aggravated use of the dollar as a geopolitical weapon, that you've started to see some pushback, particularly from the Russians, from the Chinese, to a lesser degree by the Europeans, and one can't blame them. But to try to come up with an alternative to the current system is going to be very difficult, because you do have all of these network effects that are out there, and we are where we are. We always start from here. Yeah. There's something about these complex adaptive systems that they're all path dependent.
Yeah.
The old joke, I wouldn't, if I were you, I wouldn't start from here, but we are where we are. I personally think that it will take an aggravation of the current crisis before people do start to fundamentally rethink the question of the international monetary system. At the moment, I mean, it's often referred to as an international monetary non-system because there are no rules. A system is based on, it's a bit like a club. You choose to become a member of the club, but if you're a member of the club, there's certain rules you have to follow.
Yeah.
Got to wear a tie when you're at the bar after 4 o'clock. So all of these things, and it really does demand that the U.S., of course, becomes convinced that somehow the current none system is not good for it. That it would be better for the U.S. if the U.S. were subject to certain rules that also were binding on other people. That would be better for everybody. But clearly we're not there yet. And as you're well aware, in the context of the current administration, the idea that there is solidarity in the system and that working cooperatively will bring benefits to everybody, that mentality has been replaced, as far as I can tell, by I only win if you lose, which is a totally different way of looking at the world.
Well, it's been fantastic speaking to you. I'm gonna finish off here with there's a number of questions we ask all our guests. We call it the intersection. The one question is there one person, living or dead, who you'd love to interview more than anybody else?
Oh, I think the master, Keynes. And the reason why, it goes back to something that you mentioned before, is most people don't have the courage to say, I was wrong, and let's have another think. Whereas Keynes was absolute master at this, and he wrote the general theory in 1936, which, as far as I could tell, completely went in the opposite direction of the treatise that he wrote in 1931, where the treatise basically said easy money is the answer to all our problems. By 1936, Keynes said it's not true. And my question would be, how did you have the self-confidence? And he did this in a number of occasions to basically say, I got it wrong. And of course, you remember the famous quote from the journalist who said to him, Mr. Keynes, surely you've changed your mind. And Keynes responded, when the facts change, I change my conclusions. What do you do, sir?
That's one of the best ones, right?
Brilliant line.
Are there any books that you're reading right now that you like or that you'd recommend others read?
I'm reading a book by Norman Liebrecht, and I attended a presentation by him just before the shutdown occurred in London. And the book that he's written is called Anxiety and the Jews, How Jews Changed the World from 1847 to 1947. And in one part, I guess, I'm interested in that range of territory, not just intellectually, but because the current climate seems to me to be people turning in on themselves, populism, nationalism, the right wing, and it bothers me. That one part of that, of course, is when things start to get rough, you blame the foreigners, you blame the others.
Yeah.
A very interesting book, actually, and very interesting book.
And then finally, what view do you hold that's the most controversial in your professional life?
Well, I think the one we've been talking about for most of this interview, which is that the fundamental problem is the financial cycle and the credit cycle. And it's not the business cycle and the inflation cycle. And I've been fighting that battle for 20 odd years, and all I can say is I continue to do it. In Paul Volcker's famous words, the title of his autobiography, I'm keeping at it.
Well, very good. Well, I have to tell you, Bill, I've super enjoyed this today. I find you to be kind of one of the most knowledgeable and gracious and interesting people to speak with. If you don't mind, I'm gonna try to keep in touch with you, and I'll try not to fill your email inbox up too much, but I'd love to be able to reach out and continue our conversations.
Oh, it'd be a pleasure. And the last hour or so, whatever it's been a real pleasure. And I hope much, at least, of what I've said, if not all, makes some good sense and resonates with some of the people who'll be watching the program.
Absolutely. It's always great to have a view from the inside, and I think you've been able to provide that. And I know the Real Vision listeners are gonna enjoy hearing what you have to say.
Yeah, my pleasure. Thank you very much.
Thank you.
If you're ready to go beyond the interview, make sure you visit realvision.com, where you can try Real Vision Plus for 30 days for just $1. We'll see you next time right here on Real Vision.